We're joined by Philip Diviny. He's a partner in the Tax and Revenue Group at Middletons in Melbourne. Very warm welcome to you, Philip.
Thanks, David.
Philip, we obviously saw the Henry Review unveiled with a lot of fanfare on Sunday. Can I get your general impressions first?
Well, we've been waiting 4 months for the government to come down and release this report to the public, and 138 recommendations and only 3 or 4 have been adopted.
And Philip, of course, the resources super profits tax attracted probably the most attention, the most controversial of all the recommendations, and a lot of criticism from the obvious sectors in the political landscape. Can you give us your thoughts on that? How does it work?
Well, Henry said that mining should be subject to essentially 55% taxation, a combination of corporate tax and the resource super profits tax. So what the government's done is announced a 40% resource super profits tax. So to the extent that a mining company exceeds the government bond rate in terms of rate of return, that extra profit's subject to 40% tax.
And of course, Philip, we've got the recommendation in black and white, but of course there's a lot of lobbying that's going on right now. Are we expecting a lot more water to pass under the bridge before we see an outcome?
I think that opposition will grow, David. The mining industry was very quick to come out on Sunday and oppose this move, and that lobbying is only going to continue.
One aspect of the review that's seen as a big win for business is the reduction in the corporate tax rate. Can you take us through how that will work?
Well, it's a reduction from the current rate of 30% to 28% over time. Small business gets that reduction a little bit quicker than large business. The interesting thing I find about the reduction in the corporate tax rate is that it really makes no difference to Australian resident shareholders in those listed companies, because when the personal rate doesn't come down, and it's not proposed to come down, then it really just shifts the burden of the tax from the corporate to the individual. Instead of paying 16.5% tax as a top-up tax, they'll now be paying 18.5% tax.
In particular, small business seeing that 2% reduction earlier than the broader business community. What are your thoughts there?
Well, I guess it's something for small business. I mean, on a practical level, a lot of small business operations don't operate through companies, they use trusts, and this change won't make a material difference to them. But they do get that 2% reduction just a little bit earlier than everyone else.
Philip, another major aspect of reform are the changes to the superannuation guarantee. How will that work? I understand it is gradual, and any action points for businesses to take or start thinking about now?
Well, the main change as it affects business is that the super guarantee levy, the compulsory superannuation contributions, are going up from 9% of wages to 12% of wages. But that goes up over time. It doesn't actually get to 12% until the year 2020. So for businesses, it's really important in their forthcoming wage negotiations to remember that the super guarantee is going up, and that might lead to reduced cash wage increases, because the super guarantee levy in the first instance falls on the company, but most companies enter into contracts with their employees where the super is effectively packaged up in an employee's package. So someone might get $80,000 inclusive of compulsory super, so that compulsory super is now going up, the cash component of their package would go down.
So does that mean, Philip, that employees won't see any difference in their actual take-home pay?
Well, I think over time what you're going to see is that employers give less of an increase in cash wages because they've got to give this compulsory super, and so a greater percentage of salary increases will go in super rather than cash. So
superannuation will eventually get to 12%. Is that adequate in your view?
Well, it's interesting 12% because years ago Paul Keating said that we should have compulsory super of 15%. So we haven't quite got to that level as yet. And, you know, 12% may not be enough for people to retire with and not be dependent on the welfare system for just your average worker.
In your opening, Philip, you talked about the 138 recommendations that Dr. Henry did make, the government being silent on a number of those and outright rejecting some others. What are your thoughts on further steps? What could we see in the future?
Yeah, so it was sort of 138 recommendations. We had 3 or 4 adopted. We had about 25 that were outright rejected, and we've got 100 or so in the middle. And It's important to remember with these sort of reviews, which do happen every 10 or 15 years. We had the Ralph review before this, and then the Asprey review in 1975, that a lot of these recommendations, they lie dormant for a while, but they do get activated at some future point. So for example, with the Asprey review, it recommended the introduction of capital gains tax, fringe benefits tax, consumption tax or GST, and we've now got all those taxes. Now in the case of FBT and CGT it took 10 years to get there, in the case of the GST it took 25 years before that was introduced. So a lot of these things in Henry, they may get introduced at some future point. There are recommendations in there such as the abolition of interest withholding tax, which would be a really important thing for corporates if that was ever introduced. Henry said that firstly, interest withholding tax should be abolished for Australian financial institutions to lower their borrowing costs, and that in future treaty negotiations we should try and negotiate a 0% interest withholding tax rate. Now that's got really important implications for corporates because it just affects the way in which you gear your balance sheet. It puts a massive emphasis on taking debt as part of your financing, because for foreign owned companies the debt's going to be zero tax if there's 0% withholding tax.
Can we talk about the areas that the government actually rejected, drew a line through?
Well, Henry said that we should remove the grandfathering for pre-CGT assets, and the government rejected that. Henry said let's get rid of the Medicare levy. The government has rejected that. There are other things in there about including the family home in means testing, and again the government rejected that. It's just too politically sensitive to go with. So there's about 25 of those things.
And just finally, Philip, talk us through the congestion tax that was recommended but not taken up.
Well, Henry's a renowned environmentalist, and he suggested that we have a congestion tax, that the roads be monitored, and that there be a toll that varied according to the time of day that the road was used. Now, of course, it's not practical to implement that at the moment. We simply don't have enough roads that are subject to that sort of monitoring, but you might find 10 or 15 years down the track that that sort of measure is introduced, at least in part.
Well, Philip Diviny, thank you again for your time.
Thanks, David.
That was Philip Diviny, a partner in the Tax and Revenue Group at Middletons in Melbourne.